Hello everybody and welcome back. This is chapter 9 of the TSR Masterclass. A very important lecture. Same goes with chapter 8, right? So in chapter 8 we learned about the weekly profiles and how exactly we can use the weekly profiles to anticipate the draw on liquidity of the week and how to actually place ourselves in the expansion leg, okay? Now, Chapter 9 ties into Chapter 8 as we are now going to dive into the daily candle. So first we learned about the lower time frame market profiles. This was a few chapters back. Then we talked about ranges. Then we talked about the weekly profiles. And now we're on to the daily profiles. Keep in mind, some of these slides are copied directly from chapter 8. So the first 2 or 3 slides are exactly the same as they do apply. All right. Now, before moving forward, I would like to mention that the candlestick formations are all very similar. All right. So don't get bored and also do not overcomplicate things. Sometimes the reason why you keep on losing in these markets is because you are overcomplicating subjects, topics, concepts, models, strategies that are supposed to be simple. The more you complicate, the more you will fail, all right? Especially in trading and specifically with CRT, right? You do not want to get into an analysis paralysis state of mind when you are on the charts. Simplify everything. All right, so chapter 9, understanding the candle, how candles form. This slide is extracted directly from chapter 8, so bear with me here. But repetition is always a good thing, okay? So there are 2 types of ranges. We have a timed range and a price range. What are the difference? Don't worry, I will tell you right now. A timed range can be seen as a candlestick, a kill zone, a session, etc. All right, an IPTA data range is in fact a timed range. Why? It is based on the 20-day timed range, the 40-day timed range, and the 60-day timed range. Why is a candlestick a timed range? From the open to close, there is a designated time that happens, right? So what I mean by this is a candlestick will open at 9 a.m. and close at 10 a.m. That is a timed range, not a price range. All right, a kill zone, same thing. There's a start and finish to that kill zone, and the same thing goes with the sessions. Now, a price range can be viewed as a dealing range, an expansion leg, a swing high to swing low, anything in the charts that you see. Why? You are measuring a price range from highs and lows. All right, not a specific time, not a session high and session low. That would be a timed range. However, a swing high and swing low that overlaps multiple sessions, mainly for swing traders, right? This is a price range and not a timed range. There will be price ranges within timed ranges and timed ranges within price ranges, okay? Every candle on your chart is a range in itself, a timed range in specific. This means that you can divide each candlestick into different phases. A lot of you guys may have looked over this sentence last chapter. I am repeating it this chapter, and I'm going to put some importance on this point right here. Write it down if you haven't. All right. So on the right side of the screen here, we can see the normal price range, which is down below, and the timed range, which is right here. So a timed range is the candlestick. We have the open right here. We have the low right here, low aligning with the low, and the close, right? So we have the high and then the close. What happened with price in this candlestick? We had a ranging market. We manipulated below the open here, right? This is the open, manipulate below the open and expand to the upside. Classic power of 3, okay? Next, down below, what do we have? We have a price range within the dealing range, right? So we expanded into a low, turtle souping a low here. This range high to range low in itself is a price range, not a timed range. Okay, so this is the same candle from above, and I'm showing you that we have a price range within the timed range. Of course, the low to the high here is a price range as well. All right. Now, the different ways that a candlestick can form. There are 6 different ways that a candlestick can form. This slide as well has been extracted from chapter 8. Bear with me here. 6 different ways that a candlestick can form. We have the classic buy and sell candles right here. We have a buy candle and a sell candle, right? The open, low, high, close, and the open, high, low, and close. Okay, we have a buy candle range. What exactly is this? And we have a bearish and bullish reversal candle. Okay, so a bearish and bullish reversal candle are right here. So we have the open, low, reversal at the lows, potentially hitting a key level, turtle soup, expansion to the upside, high, and then close. This is a bullish reversal candle as we reversed at the lows and not only expanded. Okay, this is the bearish reversal candle. We have the open, high into a key level, low, and then close. So we reversed at the key level up here. Okay, this is the range candle. So we have a buy candle range and a sell candle range. Buy candle range is when we close above the open, and a sell candle range is when we close below the open. Okay, understanding the above is very important because we can apply them to absolutely any candle. A daily, a weekly, a 4-hour, and even down to a 1-minute chart. Not recommended, however, doable. Within each of the above candles, we have different phases called profiles. So within each higher time frame candle here, we're going to locate and see different market profiles, and that's exactly how we will anticipate the closing of this candle. Meaning at the open, we don't exactly know how exactly the candlestick will form until a key level is hit at the bottom. We see a change in state of delivery. Okay, we can now anticipate a reversal if we got the expansion market profile into a key level, right? So that's just one example of what could potentially play out. All right, so this is an open, low, high, close, and open, high, low, close chart. We can see very, very straightforward here and direct. On a bullish candle, we have the open at the lower end. We create a low as we manipulate below the open. This wick right here is where you would find your entry model if you were bullish. And of course, we have the high and the close. It's the opposite for a bearish candlestick, right? Price will close below its open, making it a bearish candlestick. Price will open, manipulate above its opening price, and this works on every single time frame candle. Okay, so price will open, manipulate above its open. You will find your entry model in this specific wick if you are bearish, creating the high and expanding lower to the downside, creating the low of the candle, coming back up with a slight retracement and closing. All right, so very straightforward here, very simple, nothing to complicate. The reason I'm explaining this open, low, high, close and open, high, low, close is because if you divide this candlestick into 3 phases, then you can locate the power of 3, and that's exactly what you should be doing. Okay, next, the daily candle. There are 3 main ways that the daily candle can form. We will talk about 5 of them, but there are 3 main ways. Okay, all of which are a combination of different market profiles. The lower time frame market profiles, that was basically taught in the previous chapters, even before chapter 8. Okay, in order to anticipate the daily candle formation, you must put your focus on key levels, PD arrays, and ranges, such as dealing ranges and expansion ranges, as these all work together with the market profiles that form the daily candle. Okay, the lower time frame market profiles are all price based, while the profiles attached to the daily candle are time and price based. We'll dive deeper into this in the next few slides here. The goal is to divide the daily candle into separate phases to get a deeper understanding of the actual profiles themselves. So to the right side of us here, we have this image was actually extracted from the weekly profile chapter, so chapter 8. However, still can be used. Just to refresh your mind, we have the opening price of a bullish expansion candle, right? So on the lower time frame here, we can see price expanded. On the higher time frame, this translates to one single candlestick. Okay, so we have the open of the higher time frame candlestick, open on the lower time frame. Manipulation on the higher time frame candlestick, looking like a wick. Manipulation on the lower time frame below the open, we are bullish, anticipating a bullish expansion leg, tapping into a rejection block, so a wick here. The wick took liquidity, created new liquidity, therefore it's a rejection block. Okay, tapping into it, finding your change in state of delivery and your entry model below the open, and expansion to the upside, retracement, expansion, range, expansion. Why did we continue expanding after the range here? Because the draw on liquidity was not yet hit. Then we form the high and retrace back to the downside with a ranging market profile to finally close. Okay, very simple and straightforward. The weekly and daily profiles work in the same way. The only difference is the fact that you are dividing the daily candle instead of the weekly candle. This is a spelling mistake, an error here. Sorry about that. Let me just repeat what I just said. The weekly and daily profiles work in the same way. The only difference is the fact that you are dividing the daily candle instead of the weekly candle. So replace daily here with weekly. Okay. I want to bring something else up. So instead of looking for the profiles within a weekly candle, of course you are looking at the profiles within the daily candle. However, they work in conjunction, meaning if you have a weekly profile anticipation, right, for the upcoming week, let's just say, well, you now can anticipate what days of the week can potentially form a specific daily profile. So if you're anticipating a Wednesday reversal for your weekly profile, then what daily profile can we expect on Wednesday? Well, we can likely expect a key level to be hit on the daily profile on Wednesday, forming a reversal. So we'll talk about the different daily profiles. However, I hope you understand what I mean here when I say you can use the daily profiles within the weekly profiles to set yourself up for a better trade. Okay? Now, the daily candle. As I mentioned before, there are up to 5 different daily profiles, but 3 main ones. All right? The 3 to 5 different daily profiles will allow you to anticipate the open high low close and the open low high close of the daily candle. Using a daily profile will help you break down the daily candles on your charts. Okay? Within the daily profile and the daily candles, we will find the lower time frame market profiles. The daily market profiles help in determining the intraday session bias plus narrative. So have you ever came across or Have you ever opened your laptop about to head into the New York AM session and you have no idea what the session bias and narrative is? Well, don't worry, this chapter is exactly for you, as I will be explaining what happens if the Asia session expands or ranges, what happens when London session does this, what happens, right? So I'm going to explain everything, okay? Understanding the daily profiles will allow you to identify the correct lower time frame draw on liquidity and other targets. Okay, so if you are ever wondering how come you have no idea where the targets for the daily candle are, it's because you do not know what a daily profile is. Okay, so understanding the profiles will allow you to identify the correct lower time frame drawn liquidity, at least for the session, and then with practice for the day. Okay, validating the anticipation of the daily profile comes down to using the appropriate tools. These are the tools that you should use in order to validate your anticipation of the daily candle or profile. Okay, so what are the tools? First tool is a key level. Very important. If you don't have a key level, forget about executing a trade. All right, next we have the lower time frame market profiles. As I mentioned before, there are multiple lower time frame market profiles within one daily candle profile. The next tool that we use are PD arrays. Now you can actually mix the PD arrays into the key level category, as they are the same thing. PD arrays are key levels, highs and lows are key levels. They are the same thing. PD arrays can be seen as a fair value gap, a breaker block, an order block, etc. Okay, and last but not least, we will use the session narratives as well as a tool. Okay. Key factors, key takeaways, write these down. So key factors to determining the correct daily candle profile. Use a weekly candle profile anticipation to help you determine the daily candle profile. Okay? This is touching base on exactly what I explained beforehand. If you are anticipating a Wednesday reversal profile for the week, then on Wednesday, you should be expecting a reversal profile for the daily candle as well. Okay? There are 6 4-hour candles within each daily candle. This means that you can divide the daily candle into 2 halves. The first half is represented by the Asia opening kill zone and the London opening kill zone. The second half is represented by the New York opening kill zone, the London close, and the New York PM session kill zone. All right, so I explained this part very quickly. Just keep in mind, this is probably one of the most important parts of the entire lecture here. You can divide the daily candle into 2 parts. Choose one half to play with, and find the power of 3 within the first 3 candles or the last 3 candles. Why? If there are 6 4-hour candles within a daily range, then that means there are 3 candles within the first half and 3 candles within the second half. You are bound to locate a power of 3 within one half of the day. Okay? Using the information from previous sessions. Using the prior knowledge, we understand that one daily profile consists of multiple sessions. We can use this information to help us further anticipate the daily profile before it is actually completed. In order to use the information to our advantage, we must first understand the if-then rule, the if-then principle. What does this mean? So first off, the if-then rule, I mentioned this on my YouTube lectures. Okay, this is not something new. Many traders use this rule. What does it mean? If something happens, then something else should happen. That's all it means. So if London session is expanding, then New York session should do something else. Okay, so think like this. If the Asia session ranges or expands, then the London session should expand, range, or retrace. Now, this is not correct. This is a incorrect statement. I was just giving options here, trying to put the idea of what the if-then rule actually is. Okay, so apply this way of thinking prior to entering a specific session. So before you think about executing a trade during the New York session or London session, always apply this way of thinking prior to actually even entering the session, okay? So the 3 daily candle profiles. There are 3 main daily candle profiles, all of which are based on the 6 different candle formations discussed in the second slide of this presentation. The 3 main daily candle formations, also known as profiles, are as follows. So number 1, we have the classic distribution retracement candle. We'll call this an expansion. We have a New York session continuation. This would be another expansion candle. And of course, we have the New York session reversal, range to reversal. We'll talk about this deeper. You'll be able to notice the power of 3 the easiest with the last example here. Okay, there are 2 different classic retracement daily profiles and 2 different New York session reversal daily profiles, all of which will be covered in the next slides. So before I mentioned that there are 5 daily profiles, but 3 main ones. So we have 2 different New York session reversal profiles. And of course, we have 2 different classic distribution retracement daily profiles. Okay, we'll dive deep into this right now. Okay, key components before we actually talk about the profiles. The 3 main daily candle formations are as follows right here. So we have 2 classic distribution retracements. We have 1 New York session continuation and 2 types of New York session reversals. The first 2 daily profiles. This is very important, write this down. The first 2 daily profiles that we will discuss put focus on the Asia opening range and the London Open. This ultimately means that the first 2 daily profiles deal with the first 3 4-hour candles of the day. Okay, write that down. The 3 remaining daily profiles, so the New York session continuation and the 2 New York session reversals, will have more focus on the New York Open until the closing bell. These 3 profiles deal with the last 3 4-hour candles of the daily range. Write that down. Alright guys, so this is the classic distribution retracement candle number 1. A classic expansion candle, some might say. So looking at this chart in front of you, I guess you can call it, we have the Asia range, the London Open, the New York Open, and the London close. I did not draw out the end of the day here. Keep in mind, there are a few more continuation sessions, such as the New York PM session, the New York lunch, and so on. Okay, so first off, the Asia range, the Asia opening kill zone, is from 20 o'clock, 8 p.m. up until midnight. The London Open opens at 1 a.m., closes at 5 a.m. We then have the continuation London, so London lunch, some may call it. Then we have New York Open at 7 a.m. 10 a.m. marks the beginning of the London closing session or kill zone. And of course, 12 p.m., so lunchtime, marks the close, right? So the London close. Okay. So each kill zone has its very own characteristics. The Asia is the first 2 4-hour candles of the day. So right here we would have 2 4-hour candles. Price will usually form a CRT with these candles. So the first candle may be the CRT range, or the second candle may be the CRT range in the Asia range. We're using a 4-hour chart for that. During the London Open, price will usually purge one end of the CRT which formed during the Asia session, Asia opening kill zone, from 8 p.m. up until midnight. So one end should be purged during the London Open, tapping into a key level, as we can see right here, a key level. And then, of course, expanding up towards the DOL. So the DOL being the draw on liquidity, which would eventually be reached during the London close. As you can see, we had a New York session retracement here. This is why we call this a classic distribution retracement candle. We are distributing price to the upside, and we have a retracement during the New York Open. Okay, of course, drawn liquidity is reached during the London close. So let's break this down some more. In the next slide, we'll see a lower time frame view of this exact setup here. We would have Asia session range forming a CRT range, right? So Asia session creating a range, London Open manipulating that range, tapping a key level, causing a reversal expansion through the London lunch into the New York Open. Then we get a retracement, can get an entry long here, and taking profits in the London close. Let's break this down some more. So firstly, we have the Asia, London, New York, and London close. As you can see, the range on the lower time frame, manipulation, tapping the key level, expansion to the upside, breaking highs instead of breaking lows. We start rejecting lows and breaking highs, coming back up into the New York Open with a retracement, turtle soup, a low, and finally tapping into the key level during the London close. So this would of course be looking at price on a 15-minute and 5-minute chart. Okay, so instead of looking at a 4-hour from the higher time frame, you would want to drop down to a 15-minute or 5-minute chart to locate your market profiles. As you can see, we have a ranging profile, then followed by a manipulation profile. Why did we manipulate here? Why did we not expand? Because we were ranging above a key level. Range above a key level equals manipulation. Manipulation into the key level below a CRT range, ideally. And then once we manipulate, we shall see expansion to the upside. Expanding, draw on liquidity has not been reached yet, and we're in the New York Open. We expect to see a retracement profile, and then once a turtle soup occurs at the correct PDRA, we can continue to see the expansion to the upside towards the draw on liquidity of this session, or day for that matter. Okay? So basically, all that being said, it means go onto a 15-minute or 5-minute chart to locate the lower time frame market profiles. All right, so little summary. Asia session will usually be a range. The London Open will be the manipulation, testing a key level and then causing the expansion towards the drawn liquidity. And the New York Open continues the expansion higher until the draw on liquidity is reached. So that finalizes profile number 1, which would be the classic distribution retracement candle number 1. Okay, moving on, we have the classic distribution retracement candle number 2, another classic expansion candle, just in another profile, another format. So in this profile, we actually see the key level being tapped during the Asia opening kill zone. When this happens, price will expand right away off the start and not tap into a key level during the London Open. So unlike the first example right here, as you can see, we tapped the key level and had a manipulation event during the London Open. In this classic expansion candle number 2, we can see the key level was tapped during the Asia session and there was no manipulation during the London Open. So when you see a key level being hit during Asia session causing an expansion, you can expect London Open to continue expanding to the upside, okay? Rather than obviously manipulating into the key level like the previous profile. Expansion will continue until the opposing draw on liquidity is hit, which will likely be in the London close once again, okay? So let's break this down a little more. On the lower time frame, a 5-minute or 15-minute time frame, you can see the daily candle starts with an expansion right away from the Asia session. So we hit a key level, caused a reversal, and expanded to the upside. Now, the London session continues the expansion as we are rejecting lows and breaking highs. New York Open did not touch the draw on liquidity into the London close, finally tapping the draw on liquidity after the final turtle soup. This is where you can locate a low hanging fruit strategy, model, or trade, okay? So London Open will continue expanding because the key level was already hit during the Asia range. So that's the most important factor of this profile and how it differentiates from the first one. Let me repeat it so you guys don't get confused. The London Open will continue the expansion to the upside because the key level was hit and tested during the Asia session, causing a reversal. Okay? Very important. So that finalizes the second daily market profile. Let's move on to number 3, which is the New York session continuation profile. So this daily market profile puts most of its focus on the last 3-hour candles of the, 4-hour candles of the day. Okay, so this profile focuses more on the second half of the day rather than the first half, meaning the New York Open and the London close will be the main focus of this daily market profile. Okay, so the London Open expanded to the upside overnight. Now we need to determine what will happen during the New York Open and the London close. First, we must ask ourselves if London has already hit the opposing draw on liquidity or not. If, in fact, London Open touched or tested the key level, then New York will likely be a reversal rather than a continuation. However, if the draw on liquidity was not reached during the London session, then New York Open will be an expansion continuation up until the London close when the key level draw on liquidity is finally reached. Okay? In this example, in specific, London has not reached the draw on liquidity, so the New York Open will likely expand higher, as we can see right here. Now, what does this look like? On the lower time frame, it becomes a little more obvious. This is an OTE style setup. When I say there will be a New York session OTE, New York session optimal trade entry, it means that price will retrace until the OTE on the Fibonacci, which are our very specific levels, onto those levels and then expanding higher. Of course, within those levels, you need to pair PD arrays, which can be your key levels, and then find a CRT at those key levels in the OTE and see the expansion higher during the New York session. That's exactly how you want to place your setup, how you want to place your entry when you're anticipating this exact model. I just explained to you how to trade this, okay? Very, very straightforward. So during the New York Open, we're going to have a turtle soup and then, of course, continue the expansion higher towards the drawn liquidity. Asia range was ranging, key level was hit, London Open expanded. However, the drawn liquidity was still not reached. We were ranging for the remaining London session, manipulated a low OTE style setup, entry long as we turtle soup the low and expand towards the draw on liquidity. That finalizes this daily market profile. Okay, now on to the first New York session reversal profile. So this is a range to reversal. Okay, very explosive movement. So when these daily profiles form, you'll usually see some explosive price movement. You're going to probably be able to enter longs and shorts, or one of each, depending on your ability to be in front of your charts. Okay. So the London Open has almost reached a key level. In most cases, we will anticipate the reversal coming from New York Open after the next key level is hit. Okay? So London Open expanding towards the key level. Why are we expanding during the London session? Because the Asia session already tested the key level here. Okay, so Asia session tests a key level. London expands. However, the drawn liquidity was not yet hit. New York session opens, taps the key level finally, and we see the reversal. This is an explosive price movement. Okay. Now let's break this down just a little more. We can see the manipulation happening during the Asia session, expanding higher. London has yet to reach the key level, draw on liquidity. New York taps the draw on liquidity and reverses to the downside all the way to the opposing key level that was hit during the Asia session. So you can be targeting the Asia session lows. Okay? This is a classic Asia session model where we turtle soup the Asia session highs and we target the Asia session lows. Okay, of course, add a key level in there and you have a model. All right, so New York Open tested the key level and immediately reversed. That's exactly what this model is. That's where you'll find your entry, and we can move on right now. We have the New York session reversal number 2, the last and final daily market profile. I know I'm going quick here, guys, but trust me, you're going to need to rewatch this a few times, as this might be the, I guess you can say, third most important lecture in this entire masterclass. Anyways, I'm going quick because I want this to be as direct and as straightforward as it can possibly get. I don't want to waste any time. I don't want to drag this longer than it needs to be. Okay? Now, let's talk about the last and final market profile. The New York session reversal number 2, where price will be going from a range into a reversal. Okay? So the first half of the day, price will mainly be ranging. During the New York Open, price manipulates below the range into a higher time frame key level, and then it expands higher from there. Okay? So as you can see, the first half of the day, price is ranging, and then during the New York Open, we target a key level below the Asia session and London session. So we are sweeping, turtle souping the Asia session lows and the London session lows into a key level. So this can potentially be a CRT setup here with a key level as confluence, and then expanding higher towards the opposing drawn liquidity. This is a very high probability setup. Okay, so your main focus should be on finding these setups, right? We have the classic power of 3 here. Range, manipulate, distribute. Where are we ranging? During the Asia range and the London session. When do we manipulate? During the New York Open. When do we continue to expand and distribute? The London close. Okay? As you can see, we are turtle souping the Asia session lows and the New York session lows into the key level here. Okay? Very, Very, very straightforward. So this is the reversal at the lows. Now, why did we not reverse during the Asia range or the London range? Why? Because the key level was not yet hit. We were ranging above the key level. Ranging above a key level, manipulating into the key level, causing the reversal. This is exactly how market profiles work. And this marks the end of chapter 9. I really hope you enjoyed this lecture. I hope you took notes, as this is a very, very important one. I hope you guys will go study, back test, front test, and create your own weekly analysis reports as well as daily reports. For the intraday traders, your daily reports are more important than the weekly reports. That does not mean you do not need to do any weekly analysis reports. I'm just telling you that there is a hierarchy for you guys, as you're mainly trading session. You're mainly trading the session, and you're not trading the entire daily range, right? You're trading a session range. So the intraday is more important for you. The daily profiles will play a bigger factor for you. Anyways, with that being said, get back to the charts, continue studying, and I will see you guys tomorrow during the live trading session. Bye-bye.